US payrolls, because data out of the world's biggest economy has recently been quite uneven. So investors want to see what's in store in terms of potential for consumer spending. And unfortunately, I think that the number of payrolls that will be lost will come up from January, and that the unemployment rate will also tick a little bit higher, but not high enough to cast doubt on the big picture recovery story.
Put some numbers on it for us. House view, what are you looking for? And Diane, at the same time, let's bring up the graphic with our forecasts.
I think that the payrolls loss will be 45,000 and the unemployment rate is likely to tick up to 9.8%, and it is going to stay between 9.5 and 10 for the next few months. So unfortunately, this does not bode very well for consumption in the first and second quarter of this year. However, U.S. growth is driven primarily by inventory rebuilding right now. So the pace of expansion will continue to be relatively fast, despite the fact that the consumer is not that strong.
Yeah, Dariusz, this sustainability and growth pattern, really what we're looking at in all major economies. Australia on the agenda tomorrow because we might see another interest rate hike. How are you treating that, and how are you treating the Australian dollar ahead of that announcement?
I believe that it's very unlikely for the RBA not to raise interest rates, given that their comments have been quite bullish regarding growth outlook, and also regarding how huge surge in investments in factories is leading to a buildup of inflationary pressures. So increase by 25 basis points, I think, is a given. And because markets are expecting that, I don't think that there will be any major boost to the Aussie from that number. But definitely we should be moving above the 90 level with which the currency has been struggling recently.
That's a short-term picture. I'm curious about your long-term, because you've got a target of 87 cents by year-end to the US dollar, which is curious if we're talking about this growing interest rate differential and also some strength still from China. What's the reason why you think the currency will be tracking lower by year-end?
I believe that most currencies will fall against the dollar starting from the spring because investors will focus on the fact that when fiscal stimulus packages in China and the US run their course by the end of this year, private sector demand will not be strong enough to replace public spending. And therefore, there is a very high risk of a double dip in the global economy, which I think will materialize in Q4, Q1 next year. And this obviously will bring back the flight to safety trend in the currency markets, where everybody is flocking back to the dollar, which will be negative for the Aussie and other Asian currencies.
Dariusz, back to the US economy. As far as the data goes for the rest of the quarter, do you think investors would be well advised to be very sceptical of the headline numbers, especially given the fact that a lot of these figures are going to be distorted by the effects of the severe weather that we've been having? Are we in for a period of volatility with the data?
I think that the underlying trend in U.S. data will continue to show improvement in the first and second quarter, possibly also in the third quarter of this year. The uneven part will largely be the housing market, where we saw really dismal sales numbers last week. But by and large, we are expecting that the economy will continue to expand very fast. But at the same time, much of the growth will not come from final demand. Industrial production will rise to a large degree because of inventory rebuilding, which will help the Fed to stay put. And I think the Fed will stay put until the second half of next year. So this will limit any appreciation in the greenback.
All right. Listen, Dariusz, great to talk to you, sir. Thanks for the time. Dariusz Kowalczyk, Chief Investment Strategist, SJS Markets Limited, live from our